Hey guys, it is Saturday, January 19th, 2019, and we're taking a look at the S&P 500 so we can sort of catch up on where we're at over this course of this long weekend ahead of starting January week 4 of trading for the S&P. Market is closed on Monday in observance of Martin Luther King's birthday, so all of the options that would usually expire on Monday will expire on Tuesday instead. Okay, so here we are. Here is our 2019 low that was made on the second trading day. And here we are as we close out the first monthly OPEX of 2019, printing at our high for the year and closing at our high for the year. Our high for the year so far took us to 26.75 and our close was at 26.70. Something that I did during the sell-off of 2018 that helped us a lot was keep track of levels where we made our closing lows and where we made really profound intraday lows that marked our swings on the way down. And I kept track of these levels and I would put them on the intraday chart and on the list of levels that I put out sometimes. And I would call them edges. And that's exactly what those ended up being. They ended up being levels where we came back to and we would sit sideways intraday or sit sideways for a few days and then boom, pop out over them, or we would come down and hold support sideways for a few days and either bounce off of them or break back below them. You can see this one edge here. This was a really major level. This was the first big intraday low. The very first big intraday low was 27.10.51, but then the one that sort of set a swing low for us that lasted for about 6 weeks was this 26.03.54. We set that low intraday. We bounced off of it by like 30 points going into the close. It was crazy. And then we never looked back and never came back or broke that low until December 10th. We held it from that point in October through the whole month of November and into the second week or so of December until we finally broke it. And when we broke it, we traded down to 25.83 and then followed that up at the Fed meeting with a move to 25.85, an impulse intraday high at 25.85, and then rolled over and liquidated off of that move in December. So that became a level known as the scene of the crime, and we've traded back to this and traded around that quite a bit. So this area from 25.85 to 26.03 has been a point of consolidation. You can see all the sideways moves against this here, and then finally on Tuesday of this week we poked our head out above this 26.03, took it out, and came back here on Thursday and back tested and held it, and have moved up from there. So 25.85 to 26.03 really still marks a big line in the sand for us. Our 10-day simple moving average, look where it was on Friday's close. That is going to poke its head over it on the start of next week and offer us yet an even higher level from which we can use as support. The 10-day simple moving average is soon going to cross up through the 50-day simple moving average as well. That's going to produce a buy signal that's going to take us higher unless the market treats it as an overbought signal. I warned about that back here when our 10-day crossed up through our 20-day, because back in 2018, every time we had a rally that would get our 10-day simple moving average moving up again and coming up for a cross on up through the next simple moving average that was above it, every time it came to it, the market would roll over and sell off. It would use it as an event to get out. It would symbolize an overbought condition. And here we are with many green days in a row. People are trying to shop around the overbought rule, the overbought term. I kept hearing that mentioned a lot by the talking heads on Friday. I bet because a lot of them sold here at the approach to the 50-day and are pissed that they sold and are looking for using their airtime on CNBC to try and get the market pushed down. And maybe they'll be successful. Maybe this is the overbought signal coming our way next week. It could be as soon as Tuesday. I mean, this thing is moving up at quite a clip. It could meet and be kissing with the 50-day on Tuesday, and the market could treat it as an overbought signal. We could trade to a higher high and then roll over from there. We will see, but that is coming our way. I want to talk about something as well Just as these intraday lows and these intraday closing low levels were really important and good records to keep track of and levels that we came back to trade around, we are going to come back and trade around these intraday highs, but these closing levels as well. And as we make these new intraday highs, you see that it's important for us to make a higher close over the previous day as well, because when we don't, we sell off. You can see it coming in here. Okay, so on this low press down, our first and really only big bearish day of 2019 so far. The next day we came in and we rallied up and we made sure to make a new closing high for the year over the one that we had printed on the first trading day. And then the next day we made another higher high, intraday high, and made a new closing high over the previous day. And we did it the next day, and the next day, and the next day. And then that's where the market decided to take a breather. We came in the next day, we didn't make a new closing high, we didn't make a new intraday high, we sort of just sat sideways. And there was where we had a little sell-off. And this low here that we took on the 14th is just about a perfect 1% off of the high that we made here. So that's all you got. You got a 1% off dip, and then from there, boom, we've taken off from there. And once again, the higher intraday high and the higher close over what was our existing 2019 high. And again, higher intraday high here, and even though it rejected the 50-day and sold off, it was a higher close than the day before. And that, is what gave us the fuel to print another higher high, higher closing high, higher high, higher closing high. But what's going on now is this. Look at how much space there is. This is a huge difference between the two closing levels, and a huge difference here between the two closing levels. So if we are going to come back down now off of this and back test these closing levels, it's going to be a deeper cut. It's going to be a little bit more painful. So we might get some volatility coming our way soon. As we trade up to these higher highs, we've got to come down. We've got to hold above the previous closing high, and when we don't hold and make a higher closing high, we correct down, and we've now got these big spaces between the closes to mark our levels where we would trade back to. So these are going to become edges, these closes. And our rule is that if we make an intraday high, a new intraday high for 2019, we must make a new closing high for 2019 to go along with it. Otherwise, we just have to approach the following day assuming that we are probably going to trade flat or lower. And our correction could be anything from 1% over the course of just a couple of days, like we saw here, or it could be something bigger that takes us back down to test a previous closing high level. These will become edges for us. And we're going to mix in there the fact that we have our 50-day and our 10-day and our 20-day to contend with on the way down. And we're also going to keep track of where our halfway back is at. Right now for the year, our halfway back is at 25.59. That's this low here, added to our high from Friday. Together, divide by 2. This is our 50% line in the sand for the whole year's trading range. And look at it. When you look to the left, you see a little poke above this level here, and then this sort of sideways consolidation. Here was an outside reversal day. I remember trading this one. I was so mad in the morning about this one because it was shenanigans that had started in the ES overnight. It had us opening up lower, below the day before, but buyers came in like the cavalry and took us up. And once we started taking out the previous day's open and closing levels, boom, you have yourself a bullish outside reversal day. And we had one of those again here on Thursday where we opened down lower, shenanigans overnight in the ES. We come in, we gap down open, we fill that gap, we trade above the previous day's high, and there you have it, a bullish outside reversal day. So we were doing things like this, but in the opposite. We were having bearish engulfing outside reversal days like crazy in 2018 at the end there, and now we're having the bullish outside engulfing and reversal days to the upside here in 2019. So again, these intraday highs must be followed up with an intraday closing high, and if we don't make a closing high, then we have to assume we might get a sideways day the next day, and then followed by another day lower, or we could even just start lower the next day. We start with a 1% correction, and then we work up from there, and we figure in, would 2% get us back to the previous closing high? Would that be enough to feed the beast? Would that be enough to bring in buyers? If not, then we go to the next day's closing high. How much of a percent off is that? Is it enough to bring in buyers? Is it enough to bring in demand? And is it holding something really important, like the 50-day simple moving average, for instance? And I hope I've reshot this video 3 or 4 times. I hope I'm not repeating myself when I say this, but we do have our 10-day getting ready to cross our 50-day, and that is either going to be a profound buying event or it's going to be a profound overbought event. But the market will react to it in some way. I'm pretty confident about that it will react in some way to it. So know that that's coming our way. And that way, if we come in and we start selling off, you're not like, what the hell happened? Why are we selling off? Well, look at those simple moving averages and think about that. Look at our intraday high versus where we closed our last high on. Where are we trading at in terms of that? Use your daily chart. Your daily chart is your friend when we're making these profound moves. Your intraday chart helps you with your entries and your exits, refining those, on your, especially as an options trader. But when you're looking and choosing strikes, you got to go to your daily chart. You got to look and think about, how much higher we could go, how much lower we could go, where is the simple moving average at, and most importantly, where was the previous closing high at, the previous high of day and the previous closing high, where were those at? Okay, I hope this gave you something new to look at and think about. I think I'm even going to write a new blog post and finally add it to the lingo. It's been a long time since I added an article there because I found that what's there is quite enough fat for people to chew on as it is. And a lot of times people are having a hard time just learning and memorizing and that stuff. So maybe, adding new stuff to it was just adding more confusion. But I think it's time to add something about these closing levels because as simple as this rule is, people forget about it. But maybe if you have it in the blog, you'll go back to it. You'll remember to keep that in your arsenal as something that you can use to make better decisions about your trading. That's it. Have a great rest of your weekend. And futures will be trading Sunday night and into the morning on Monday. So it'll be interesting to see what ES does. ES took us up all the way up to 2677 after the bell with S&P. So the S&P closed at 2670, but the ES went all the way up to 2677 while we weren't looking. So obviously some people were short and hurried up and covered and got themselves out of that. And we'll see if Sunday night they take it up even higher and into Monday morning when Europe and Asia is trading the aftermath of this rally that we saw on Thursday and Friday. Okay, have a good rest of your weekend. Bye.